warahmatullahi wabarakatuh. So right now I want to do a presentation for Financial Accounting 2 subject. Chapter 6, Accounting for Revenues and Expenses. So my lecture name is Puan Siti Yusnida, Binti Mohd Yusof. Okay, so I want to introduce my group members. First is Arvin. His registration number is 06D81NF2041. Second is Aiman Hakim. His registration number is 06D81NF2017. Third, Hidayat. His registration number 06D81NF2039. And then Sirajuddin, his registration number 06D81NF2025. And I'm the last presenter. My name is Nabihah Hanis Binti Azhar. My matrix number is 06D81NF1066. Okay, nature of revenue and expenses. Definition and category of income or revenue. Inflow or enhancement of assets or decrease of liabilities. That result in increase in equity. Revenue is income that results from the ordinary or normal activities of entity. For example, car manufacturers is assembling car and then selling the cars. Categories: first, the sale of goods. Second, the rendering of service. The third one, the use of an entity's assets by others, interest, royalties, and dividend. So that's nature of revenue and expenses. Define expenses and category of expenses. Okay. Definition of expenses. Expenses are decrease in asset or increase in liabilities that results in decrease in equity. Expenses include expenses that arise in the course of ordinary activities of an entity, and losses, for example, results of carrying out entity or cost of sales, utilities expenses, and depreciation expenses. Okay, that's defined expenses. Types of expenses. So first, we have revenue expenditure and capital expenditure. So that's defined expenses and category of expenses. Recognition and measurement of revenues under MFRS 15 RE. Recognition of criteria. A. Identify the contract. A contract is an agreement between two or more parties that creates enforceable rights and obligation. B. Combination of contract and contract modifications. First, a contract includes promise to transfer goods or service to a customer. Second, performance obligations and are accounted for separately. And the last one, the entity promised to transfer the goods or service to the customer is separately identifiable from other promise in the contract. C. Performance obligations and satisfactions of performance obligations. First, promised goods or service are accounted for as separate performance obligations only if they are distinct or are part of a series of distinct goods or services. The entity has to consider the following two criteria. The first, the goods and service are capable of being distinct, meaning that customer can benefit from some service or goods on their own or in combination with readily available resources. The second criteria, the goods and service are distinct when considered in the context of the entire contract. Okay, if a good or service is identified to be distinct but is part of a series of goods and services that are substantially the same and have the same pattern of transfer, that series of goods and service must be treated as a single performance obligation when these two criteria are met. First criteria, each distinct good or service in the series is a performance obligation to be satisfied over time. The second criteria, the measure used to assess the progress of performance obligation, is the same for each distinct good or service. 6.2.2 Measurement and Journal Entries. A. Determine the transaction price. The transaction price is the amount of consideration an entity expects in exchange for transferring promised goods and service to a customer. However, the transaction price can be challenging to determine under other situations, such as when first, the transaction price is variable consideration. Second, a customer pays for the goods or serviced before or after the entity's performance, significant financing component. The third one, a customer pays in the form other than cash, non-cash consideration. And the last one, an entity pays consideration to the customer, consideration payable to customer. So that's measurement and journal entries. Determine the transaction price. Okay, variable consideration. If consideration promised in a contract includes a variable amount, performance bonus, and discount, an entity must estimate the amount of consideration entitled and include that amount in the transaction price. Subject to a constraint, if the entity's entitlement to a consideration subject to the occurrence or non-occurrence of a future event, the transaction price is considered to be variable. Can be estimated using either expected value approach. Is based on probability. Weighting the possible outcomes of a contract or most likely amount approach is amount that is most likely to be received considering the range of possible amount. So this one is variable consideration. Number 2, significant financing component. In many business transactions, when a customer pays before or after the goods or service are provided, actually the entity is receiving an entity to assess whether the arrangement contains a significant financing component. The following two factors must be considered. First factors, the difference, if any, between the amount of promised consideration and the cash selling price of the promised goods or service. The second factors, the combined effect of both of the following. First, the expect length of time between when an entity transfers the promised goods or service to a customer and when the customer pays for those goods or service. Second, the prevailing interest rates in the relevant market. So this one is significant financing component. Okay, number 3, non-cash consideration. The revenue model requires that non-cash consideration received be measured at the fair value of the consideration received. If fair value cannot be reasonably estimate, the consideration will be measured by reference to the stand-alone selling price of the good and service promised in the contract. So this one, number 3, non-cash consideration. Number 4, consideration paid or payable to the customer. The consideration payable is treated as a reduction of the transaction price revenue, unless it is related to a distinct good or service received from the customer. There is no reduction of the transaction price, and the transaction would be treated as a regular purchase similar to any other external third-party purchase. Consideration payable include coupons, vouchers, signing, bonus. So this one is number 4, consideration paid or payable to the customer. Okay, B, allocate transaction price to the performance obligation. The transaction's price should be allocated to all the performance obligations in a contract in proportion to the stand-alone selling price of each performance obligation. This is to make sure the amount of consideration to which an entity expects to be entitled in the exchange. That's the first one. The second one, the stand-alone selling price, which is not directly observable, should be estimated by considering all information: market conditions, specific factors, class of customers, reasonably available, appropriate methods for estimating. First, adjust market assessment approach. Second, the expect cost plus a margin approach. Number 3, limited circumstance And number 4, there is residual approach. So that's B, allocate transaction price to the performance obligation. Okay, C, change in transaction price resulting from contract modification, including price change orders, are covered on a separate page. Other change in transaction price should be allocated to performance obligations on the same basis as at contract inception, even if standalone selling price has changed since then. Next, amounts allocated to an already satisfied performance obligation are therefore recognized as a one-off increase or decrease in revenue when the transaction price change. However, change in transaction price should be allocated entirely to one or more, but not all performance obligations. If the same criteria is set out for allocating variable consideration to a single performance obligation are met. Changes in transaction price may result from contract modifications. If a change in transaction price takes place after the contract modification, recognition of expenses. Associating cause and effect matching principle to associate expenses with revenues and record them in simultaneous accounting periods. Systematic and rational allocation cost benefit many periods and are spread among periods. Immediate recognition costs with no link to revenue and do not benefit future periods. According to the revised MASB conceptual framework, Para 5.4 MASB 2018, the recognition of expenses occurs at the same time as the initial recognition of a liability or an increase in the carrying amount of a liability. Next, the derecognition of an asset or a decrease in the carrying amount of an asset. And expenses is recognized for an accounting period provide there is a direct relation with the revenue earned during that period. Example, selling expenses and commissions which are incurred with cost of goods sold. Second, an indirect relation with revenue earned during that period. Example, indirect operating expenses. And the last one, a measurable expiration of some assets which are not directly and or indirectly related with revenue for the said period. Example, losses which arise from pilferage or theft or accidents. Recognition of expenses. Okay, and then example. Let's go to example. So on 1st January 2018, Sarah and Nabihah acquired a van costing RM60,000 in cash. The useful life of the motor vehicle is 5 years. The business adopts the straight line method. Sales for the accounting period and 31st December 2018 is RM200,000. Show extracts of the statement of profit or loss and other comprehensive income and the statement of financial position for the financial year 2018. So that's example. And then the answer, the van's cost RM60,000 is capital expenditure. Depreciation expenses RM12,000. RM60,000 over 5 years using the straight line method is the revenue expenditure for 2018. Therefore, it is estimated using the straight line method that only RM12,000 is associated with the RM200,000 sales revenue of the business for the financial year 2018. Okay, and then 1st January 2018. So debit side, debit motor vehicle account, 60,000 RM60,000 debit side. And then credit cash at bank account, RM60,000, so credit side. Purchase a van for RM60,000 in cash. So debit motor vehicle account, RM60,000 debit side, so credit cash at bank account, RM60,000 credit side. So that's on 1st January 2018. So okay. And then 31st December 2018. So adjustment entry for depreciation expense van. So debit depreciation expenses RM12,000 debit side. So and then accumulated depreciation, credit side, so RM 12,000. So, okay. And then Sarah Sendirian Berhad. Okay. And then this one, statement of profit or loss and other comprehensive income for the year ended 31st December 2018, RM. Income sales, RM 200,000. Less expenses, which is depreciation, RM 12,000. So net profit, loss. So this one, okay. And then Sarah Sendirian Berhad, statement of financial position as at 31st December 2018. Motor vehicle RM 60,000, and then less accumulated depreciation 12,000, and then 48,000. Okay. And then presentation of revenues and expenses in financial statements. So Sarah Sendirian Berhad, statement of profit or loss and other comprehensive income for the year ended 31st December 2018. So RMK. Revenue, and then less cash of goods sold, gross profit, add other operating income, less expenses, selling and distribution expenses, administrative expenses, finance costs, profit before taxation, tax expenses, profit after taxation. So RM, that's it. So this one is presentation of revenues and expenses in financial statements. This is how you do it. So that's it. That's my presentation for Financial Accounting 2 subject, Chapter 6, Accounting for Revenue and Expenses. Chapter 6, Accounting for Revenues and Expenses. So my name is Nabihah Hanis Binti Azhar. My matrix number is 06G81NF1066. So thank you so much.